is a digital assurance and transparency manager working in the Bay Area and Northwest market. She works in the fintech space, concentrating on external audit of the ICFR. Ilona earned her BA from Fresno Pacific University, where she studied accounting, finance, and international business. She has also earned her MA from Fresno Pacific University in finance. Ilona also obtained her CPA license. She loves yoga, hanging out with her dogs Bruce and Lexi, and studying different languages and cultures. With that being said, take it away, Ilona.
Thanks so much, Jasmine, for the intro. Hi, guys. So it's really nice to be with you on this wonderful Saturday afternoon, and I appreciate you all taking the time to learn a little bit more about the investments, about budgeting, and altogether savings. So I will be sharing a little bit of everything with you throughout the session. And if you have any questions, please feel free to raise your hand or just unmute yourself and ask questions. And I believe there will be also some time for us to go over any questions at the end of the session as well. So we can do that, but without further ado, so I'm gonna go ahead and get started and share my screen with you. So let's do this. Okay. All right, and let me know if you guys can actually, let me see if I can start. Are you guys able to see? No, you cannot see the presentation, right? You can see the actual slides with notes.
Yeah, we're not seeing the full presentation.
Okay. I think that's okay. It would be okay if you guys can see some of the notes, because I think those would be helpful, and we will be kind of toggling back and forth between this presentation and a few Excel spreadsheets that I have open. All right, so first of all, we're going to start with building a budget and why it's important. So I have this information updated. Originally, I had the 2015 data, which was the first time basically when I was presenting this topic. And surprisingly, I went back on today just to see where we are at. And 5-6 years ago now, this section right here basically said that 60% of US adults gave themselves a rating of A or B for personal finance knowledge. As you can see, that had gone down a little bit to 57. But this number right here, so basically the number of people who were agreeing that they still need a little bit more guidance and help, now had gone up to 78%, it used to be 75. So as we can see, even though everyone or more than half of the population is saying that they're pretty confident when it comes to finance and budgeting, more than 70% still saying that they would like to understand a little bit more. And honestly, I think this is one of the sessions that would have helped me a lot when I was a student back in the day when I was just going to school for both my master's and my BA. I had to have multiple jobs, and I had a lot of tuition payments, a lot of bills, and not as much of income coming in. So having that budget would have made it very easy for me to figure out, how to go about payments, what the difference is between fixed versus variable expenses, how should I go about planning for those, and what it is that I need to do in order to plan, not just long term, which is very important, but also having that knowledge on a daily basis of what is my bank account balance is going to look like today or tomorrow. So basically, the most important aspect really of building your budget is looking at your income and looking at your expenses. So to go through this list, basically as far as the income and revenue goes, so anything that pertains to your salary, interests, investments, dividends, reimbursements, financial awards, scholarships, allowances, and other incomes, that's going to be all of the money that's coming in. One important aspect, which we will be talking about a little bit more in detail, is the taxable event. So it's very important for you guys early on to start understanding how and when you are taxed and which particular events would actually trigger a taxation. So for instance, if we're talking about scholarships here, let's say you have a scholarship that covers your tuition and room and board, or let's say that you have obtained a grant for a specific amount that you are able to then go ahead and expense for books or for actual day-to-day living expenses. Most of the time those are tax-free events, meaning that at the end of the year you will not be taxed for that, so it's just the free money that you will be receiving. Versus if we're thinking of salary or interest earnings or investments, all of those items, they're not tax-free. You're gonna end up paying money on it. So again, we'll revisit this portion in a little bit, but I just want to plant that seed for you guys to have that in mind going into the whole valuation of what the investments should look like. So, and then of course we have the expenses, right? And we have fixed costs, rent, taxes, insurance, student loans, your tuition payment, car payment, whatever it may be. And then you have variable costs, which are food, transportation, entertainment, and you can really add more to both of those sections. But it's just to give you an idea that fixed costs is something that you guys probably know by now, something that every single month you're going to have to pay. Every month you're paying your rent, you're paying your tuition, you're paying potentially your student loans or the interest that you're paying off of it, or car payments, auto insurance, etc. And then variable costs really just would depend on the situation that you're in. So for instance, food might actually be a fixed cost if you go to a cafeteria every single day at school. However, if you're either cooking at home or you're going out, depending on the situation, it might be a variable cost. So for that purpose, you actually would have to really account for and figure out how much really do you need per month of funds to be able to purchase food, to be able to have your transportation, like gas, for instance, also accounted for. So I'm gonna go and move forward. So this is kind of the very basic breakdown. We're gonna go a little bit into the details. This is just a slide to give you guys an idea of how you should be really starting to think about budgeting. And overall, if you're thinking of savings, before you're able to invest those savings, you need to have some. In order for you to have some savings, again, it really just depends on the situation that you're in. A good rule typically is to keep 10% of the earned wages as a saving. However, it's not a luxury that everyone can afford. So it really just depends on your situation. Sometimes you might be in a situation where you're just getting by. The important thing to remember is to ensure that you're spending money in a responsible way and the way that's not going to hurt you long term. So in the section right before me, I dialed in a little bit earlier, and there was a conversation about the fact that credit cards, you can obtain one and then in a very responsible way spend it all and then pay a lot of the interest, and it's something that's going to hurt you long term. I've definitely been there. Don't want you guys to be there either. So, but the most important thing is think about it this way. You have your income, let's say it's $50,000. Divide that by 12, right? So every single month, most of the time you're going to be earning it, your income is probably going to be bi-weekly provided to you. So every 2 weeks or maybe just twice a month. So then a portion of that is actually going to go into tax, and we're going to talk about it more in detail with the next expense related spreadsheet that I'll be sharing. But technically what you need to know is that all of this $4,100 is not what you're actually going to be earning. So a lot of the time, if we, let's say, get an offer for a job and it's either an hourly rate or an annual rate, but automatically we think, oh, we're going to earn, over $4,000. But in reality, it's much less because a lot of it goes into tax and other various related required payments. So then you really have to deduct that. And then, you will have, again, your fixed costs here, student loan, rent, utilities. They're fixed and variable just because every single month you do have to pay them, but they might vary. And then the same thing again, as we talked about food and transportation. So then here we can actually see and be able to plan. Obviously, the difference here is coming from rent, really. In a sense, it really just depends on where you're going to school and what type of housing do you have. And if you're not in school, if you're past school, obviously you might be still maybe living with your parents, or you might be sharing an apartment with somebody else, because obviously these prices are not very realistic in order for you to get an apartment. It's just for you to guys have an understanding of how to ultimately get your head around to what your bottom line is going to look like, and if it's going to be worth the long term for you to be living at a specific location in one city versus the other. So now I'm gonna go ahead and actually reshare my screen. So give me just a second, or let me do this. Okay. Are you guys able to see an Excel spreadsheet now, or no? Let me stop sharing and reshare in just a second. Okay. So the very first thing that we're going to take a look at is basically a very basic budget. So before we move into this, I do want to mention that nowadays there are multiple cell phone apps that you can actually download that would help you with budgeting. The only negative that I personally see is that most of those apps, you do have to grant them access to your banking information so that they would actually see what are the types of expenses that are coming out and what is the actual income that's coming in. And then, you know, you should have a better understanding of the types of income. So let's say, for instance, you got additional $150 or $200 for your birthday, or you know that an additional expense is coming out. It's not something that those apps would be able to foresee, because again, they're just basing the information based on what you have. I do have a list of those apps I'll share with you, but I did want to go over basically what the expense should, expense report or budget should look like. So the way that we want to build it, you usually want to start with a zero balance, and then let's say this is the portion, this is the first paycheck of the month, and this is the second paycheck of the month. It would basically correlate to the actual dates. And then here you can go through and break it down. What are the particular expenses that you are estimating to see? So for instance, again, you know that every single month you're going to pay a student loan on the first, and then the rent is also going to be on the first. So you know that this particular amount you need to have to cover it with the first paycheck. Now you might have multiple credit cards, and potentially depending on when the due dates of those cards are, you can probably, sporadically break them down in a way where you can actually pay them out throughout the entire month. And then that way, so basically every single time you do make a payment, or you know that there is an automatic payment that is scheduled, you can actually see what impact it would have on your bank account. So let's say if on the first you're receiving your paycheck and then you're having to make a payment for these two particular items right away, you know that on the second you should have $423.10 left in your bank account. So this is the type of exercise that you don't really have to stop at the end of the month. You can just keep going, and you can basically see how much of money you're able to save for the particular month, and then ultimately extrapolate that to the annual amount. So these are all of your expenses. You have ordinary expenses, which again, it's going to be a part of your personal use, right? Either it's food or gas, or maybe entertainment, maybe watching a movie, renting a movie at home. And then you have, credit cards, you have, again, fixed expenses. And then here is your income that's going to be coming in. So before I go into the details associated with the credit cards, the credit score, and the overall percentages that we want to talk about when it comes to various formula like debt to equity or debt to income, let me kind of go over the Paycheck Constitution. And I just want to make sure that you guys have that awareness so that, again, you're having a very good idea of how much you should be expecting to receive as part of your paycheck, depending, again, on what your salary is. Let me stop sharing right now and reshare. In the meantime, are there any questions?
As of now, there are no questions in the
Okay,
chat. If you have any questions, you can speak out.
great. All right. Can you guys see the paycheck composition sheet? Yep. Okay, great. All right. So within the pay, what we usually get, depending on where you work and the times that you're working, you will have your regular pay. So this is based on a payment of receiving your paycheck twice a month. So basically, let's say this is a regular pay that you're receiving. The imputed income, sometimes you don't actually know that you're getting that added into the actual check. But let's say if you're working for a company or university, like if you're working for school, for instance, that's giving you access to cafeteria for free, maybe a membership to a gym, and let's say there are additional discounts that you're able to obtain. So even though these benefits are not something that you're receiving money for, they're considered fringe benefits and added as an imputed income. So what it does, it actually increases your paycheck, but it's not the money that you will see at the end of the day, but you will get taxed on that amount. So whenever you are starting to work for someone, if they're giving you a number of various perks, ask them, is that going to be a part of the imputed income? Because if it is, not necessarily that you will be turning a job down just because of that, but you want to make sure you understand how much of that imputed income is going to be reflected on your paycheck, because that's going to be a portion that will directly be taxed and ultimately will come out from your bottom line. So then there are sometimes special payments. So let's say if you receive a bonus, if you receive an adjustment of living, cost of living, those usually are taxed at a rate of 22%, even though you might not be in a tax bracket where you are 22% yet, you might be at 10 or 15, you will still be having to pay those 22% on the, again, anything that pertains to bonuses or cost of living adjustments. So basically those three numbers get added up together, and then that's how we get to the total of what your income is. However, now we're going to take out everything that you are paying associated with medical insurance or with deductions or with taxes. So before tax deductions, they're called that way because it's a non-taxable event. So what happens, let's say, when you're actually making payment for your health insurance, for your vision plan, if you have a health savings account, which is literally you can sign up for it and you will receive a credit card. And on this credit card, let's say every single month you decide to contribute $35, your employer usually would match that particular amount. And as long as you're spending that amount on medical related expenses, not just going out, although you could, it's this particular amount is not taxed at all. Again, then dental, 401k, we'll have to talk about it separately, is also a non-taxable event. So you can actually allocate a large amount of your income, and that's going to come out from your taxable income. So it means until you withdraw that money at the age of 72, you're not paying taxes on that. So then basically this entire amount of $200 in this case is non-taxable. Then you will have your federal taxes that you're having to pay, and it's calculated again based on a very specific bracket. There is the Social Security, Medicare tax, California withholding tax, and California SSDI. So it's a disability insurance that gets paid. So then these amounts also are being withdrawn because this is the payment that you are making for taxes, social security, etc. So then out of this amount, obviously 1855 is just going out already. And then after that, if you ever have, you guys probably don't right now, but at some point you might have to pay for long-term disability, maybe life insurance, maybe a legal group protection. So this is something that's taken out after the tax deduction. So it means that at the end of the day, you're going to receive only $3,000, and it's going to be based on the fact that you're going to take the $200 deducted, and then after that, you're going to go through your bracket calculation, and it's going to be taken out additional $1,800, $1,900. Again, it really depends on how much you're making. So that varies, and we will be sharing this paycheck composition later down, after the presentation, so you can figure out what it would look like for you. Employer paid benefits, it's just for you guys to keep in mind, so that whenever again you're looking into getting a new job, also have that understanding. How much are they willing to match my HSA? How much are they willing to match my 401k? How much are they going to pay for my health insurance? So this is not something that's affecting you, cash liquidity wise. It's just something that the employer is basically providing as a benefit to you one way or another. Long story short, obviously, if you're making over $5,000, you barely will get $3,000 on hand, and this is the amount that you will have to spend. So based on this amount, that's when we're gonna go into the expense calculations and figure out how many expenses do we have. And since we only have this particular amount per month or every 2 weeks, then how much can we actually spend and still have some saved? So if you guys have any questions, please ask anytime. But just an FYI, you can go into, it doesn't have to be this website, it's just an example. You can look at what your tax brackets are. And the way that it works, usually most of you probably are single individuals, so it's going to be the first one. However, if you are married and filing jointly, then you just want to use this other section. But basically, if your parents are not claiming you and you're filing your own taxes, for the federal level, up to $9,800, you pay 10% of the tax. Again, this is not accounting for you making $9,800. This is looking for this as being the taxable income. So you guys have to take out either the standard deduction, or you have to basically take out all of the charitable contributions or whatever, a lot of the tax related items. So just keep that in mind, that it's not necessarily what you earn that gets, it's the taxable income here. And then again, as the amount increases, then the next bracket is you're going to be paying 12% versus 10, etc. And then the state of California is a little bit, the structure is the same, but it's different in the tax rate, so that you guys also keep that in mind. All right, so let me go back to the stop share. Let me go back to the budget. All right, so basically on this budget, you're able to figure out, like, this is $189 is your saving. Another way to do it is you want to actually break it down per credit card as well, and like summarize it here also. Again, we'll share the Excel output, and you guys can just change the numbers to reflect what you currently earn and what your expenses are. But based on this, you're able to actually prorate to see, okay, if I'm earning $189 at the end of the month as my savings, so for the year, I can actually have $2,272 that I could invest one way or another. So, and before you start investing into multiple various ways you can, there are a few things to consider. The first one is your credit score. It's very important. And the second one is, long term, if your goal is to purchase a house, you also want to make sure that you have a very clear idea where you need to be with respect to your overall debt that you owe versus the actual income that you're earning. So here, again, there is the current debt. You can actually see that, for instance, for your credit cards, let's say here's your credit limit and here is your current utilization. You can actually see what your utilization is looking like per credit card. The general rule is that you want to keep it under 30% of your overall credit cards to be utilized in order for you to continue growing a healthy credit score. There are various other aspects like making payments on time, having different types of expenses and credit, maybe loans, maybe student loans, your car, whatever the financial packet that you will have with your vehicle. It's also a different type of an expense that's going to go into your credit score calculation. But one of the main aspects is to make sure that your overall utilization of credit cards is under 30%. So if you have something like this and you just do this exercise, you basically can figure out this is my available credit limit and my ideal utilization at 30%, as you can see, would be this. But currently I owe this much money. So then I need to pay off 4,900 or whatever that amount is going to be in order to get to the place where I can start building a healthy credit score. So then potentially maybe instead of having this amount saved every single year, start paying more for your credit cards, because it's very important to not end up in a situation where you have a lot of debt on the credit cards, because that's where you have the most interest that you're paying. And the second thing is, I guess I don't know how much you guys care about it right now, but overall, in order for you to purchase a house, usually your debt to income ratio has to be under 43%. So if you have, again, an annual salary of 60,000, your debt to income ratio needs to be at least $25,000 or less. And as part of it, also keep in mind that usually you have to pay at least 20% down payment. If you don't, you still can qualify, but you have to pay a mortgage. It's called private mortgage insurance, PMI, which really increases your monthly payments. It's just something to keep in mind. So that's basically everything related to overall budget, expenses, and how you get to the savings number. So now that we've covered that, let's go into the actual investment portion. Yeah, let's do that. So let's see, let me stop sharing again and reshare it. There are a few things that I have open, so give me just a second, guys. Okay. All right, so the first thing, basically, when it comes to the savings, are you guys able to see my screen? Yeah, okay, great. All right, so when it comes to savings, let me see if I can do this. Yeah, it matters a lot what kind of savings you are thinking of having long-term and the investments. So you probably, when you're thinking, there are just so many different financial products that you can invest into. We'll go through them just in a minute. But the first thing to keep in mind is that depending on what you end up doing, as part of the investments, if it's not stocks, if it's almost any other type of other product, financial product, make sure that your interest is compounded monthly, not annually. So what it means is that literally every single time, let's say you are investing in a certificate of deposit, and certificate of deposit you can basically obtain at any bank. It usually requires $2,500 to $5,000 depending on this particular product that they are offering. And then they will give you a very specific interest rate that they will be paying you on an annual basis. Sometimes they'll make a payment twice a year. However, see if that interest that they're going to pay you, if it compounds, because if it compounds, it means that, let's say at the end, let's say you have purchased a $10,000 worth of a certificate, and at the end of the first month, it will, since it compounds monthly, it will basically, let's say it's 10%, a very large amount, but just for the sake of the argument, it's basically going to give you 10,000 and or like 11,000 if it's 10%, right? We have to divide it by 12 as well. But the point is that at the end of the month, before it starts the calculation for the second month, it's now going to account for $10,100 and base the interest on that, versus just if you have a non-compound interest rate, then throughout the entire year, it will just continue calculating that interest on $10,000. And I do have a calculation. I'll show you how it varies. And the higher the interest rate or the higher the invested amount, the more the difference shows. So it's pretty important to make sure that if you guys have an option to get a compound interest rate, you go with that. So in this section, we actually can see how if you're making just $25 per week for 40 years, you end up saving so much more money. So it shows how much you personally would be investing. It's all at 5% interest rate. Again, it's pretty high. It's just for the sake of an example. But then you can see what your potential interest earning. Again, obviously, the longer you have this product that you are investing into, the more interest you will be able to accumulate. So the better it is for you. So there are a number of different types of products. Again, the first one that we talked about is the certificate of deposit. Usually the interest rate on HCD is between 0.45% to 0.65. It's not a 1% even. So, and another thing is usually it's at least 6 to 9 months. So if let's say you have purchased a certificate of deposit for $2,500 and in 5 months you absolutely need that money back, you will actually get penalized for basically obtaining that, withdrawing that money sooner. And also you guys keep in mind that the overall the rate of inflation is for the last 10 to 20 years was definitely over 1%, and recently it's been as high as 2%. So for you to invest your money into a product that will give you under 1%, in a sense, it's kind of losing money long term, if it makes sense, because again, your money sitting there at that particular percentage is depreciating. It's not appreciating as fast as the basically depreciation of the overall funds is in the country. So bonds is a big way for you to also be able to invest. So there are different types of bonds. There are municipal, there are corporate, and there are government. So usually municipal bonds and government bonds, they will give you a lesser of interest rate, but they are going to be more trustworthy in a sense, because again, a corporation can potentially liquidate and go bankrupt anytime. We wouldn't expect that from our, government to cease to exist. So we know that if we are investing into a government bond, there is less risk associated with it. However, overall, bonds usually take very long time to mature. Okay, so it's 10 to 20 years. And the way that it works, think of yourself as a bank. So let's say that there are available bonds for a specific corporation or for a governmental entity. So basically you're lending that money to them. Let's say it's $10,000 or $1,000. I don't know, it can be as low as $50. And what's going to happen is that twice a year, you will receive a prorated portion of an interest on that particular bond. And let's say if the maturity is 15 years or 10 years, it means that those $50 or $100 that you have invested, you will not see that money until 10 years or 15 years, basically until the maturity reaches its end. So it's just a very long time. And in order for you guys to actually figure out if the bond is worth it, there are pretty complex math calculations that are involved. I did a few examples for annuities just to show you how it works. Annuities are very similar. The main difference is that annuities are distributed by insurance companies and it's something that you're able to make a payment for and then expect a specific period of specific amount of funds to be provided to you every single year, versus again, bonds. It's something that you're receiving only interest on for a very long period of time. And at the very end, you will see that you will actually obtain the $50 or $100 that you have invested. So they will return the principal to you. So in order for you to invest into bonds, though, you basically need to understand, is this bond worth it? You do either present value or future value calculations. Again, I'll show you in a minute what it looks like. But basically, it's very important to understand if the bond is going to appreciate long term or it's going to depreciate. How are you going to be losing money on it or making money on it? So then the next thing is stocks. Stocks, as you guys know, basically are coming from various companies. So usually when the company first starts, it's a private company. And then whenever they're trying to, build a company, expand their products, expand their markets, they usually need capital. There are different ways to go about earning additional capital, but one of them is to go basically IPO and to become a publicly traded company. So it means that they selling off a portion of their company to the public, and then you are able to become an investor in that company through the purchase of these shares. So the types of stocks, the types of shares vary. We have common and we have preferred. So the difference between common and preferred, there are two main differences. The first one is for the common shares, most of the time you don't really get the dividend distribution, and dividend distribution is provided when a company earns a specific revenue and they have enough of money to, in addition to, making various payments, they're also able to give a portion of that revenue to its shareholders, stockholders. So if you have just a regular common type of shares, you might not get that. But if you have preferred shares, which usually cost a little bit more, you will be receiving that particular dividend distribution. Another thing to keep in mind, if in the case of the company going public, and let's say after a while, if something is not working out and they're having to liquidate, preferred shareholders would be the first ones in line to receive their dividends and their portion of the actual shares that they owe before common shareholders. So it's a more favorable position. So it just has fewer risks. So, and then when it comes to dividends, again, you might expect to see those every single year as a preferred shareholder. There are also qualified and non-qualified dividends, and depending on the type of a dividend that you receive, you will be taxed differently as well. And I do want to talk about taxes. I'm running out of time drastically, but it's very important to keep in mind, basically, every single time you are investing into a specific product, what type of taxable event it's going to have. So for instance, to give you guys an example, when we talked about bonds, if it's a federal instrument, if it's a bond that associated with a federal entity, you might not actually be taxed at all at a state level, versus if you're having stocks and let's say you have sold those stocks within a year, you are going to have a short-term capital gain, and short-term capital gain is taxed as an ordinary income. So when you're considering the interest rates you are earning on different types of, financial products, make sure that you have a very good understanding of the tax implications, because sometimes you might be earning a greater percentage. However, it might be also a taxable event, which will require more funds for you to pay as part of your tax payments. All right. So now we also have mutual funds. And then as far as mutual funds go, there are actually 7 different types of mutual funds. Equity, balance, there are fund of funds, there is the marketplace. And most of the time you actually would probably see it as part of your 401k or, any type of retirement accounts. So if it's an individual retirement account, it's easier for the company that you're working with to invest into a mutual fund. And it's literally just a various pool of different funds. So let's say if you want to invest into companies that are socially responsible, so there might be a pool of those companies. and you're able to invest in all of them as part of the mutual funds. Let's say if you're only interested in specific commodity like crude oil, there might be a mutual fund that will just be covering those particular companies that are just trading oil. So positives are there are fewer risks because, again, it's kind of allocated across various types of companies. So it's not just the one singular company that you're investing. Negatives is that you have fewer choices and say, unless you're very specific and are actually directly purchasing mutual funds, then you can see if you're interested in a specific type of activity, and then you can select it. And then finally, savings account, the easiest thing. We probably all should have it. If you guys don't have it yet, try to open it. But basically, savings accounts is just your bank accounts. They don't require most of the time a specific amount to be put into the accounts on a monthly basis. Some banks require for you to maybe give $25 so that you don't get charged maintenance fees. But the negative is that your interest rate is going to be very minuscule. It might be 0.01%. So you won't really have a big saving at the end of the day with that. The positive is that it's something that you're actually able to see every single month. Let's say you add $5, $10. So you can actually see, okay, my savings account is growing, and therefore my options to actually, start investing elsewhere are also increasing. Also, if you just put funds into savings account, it's basically a non-taxable event. So from that perspective, it's pretty easy. So it's not anything that you have to worry in particular. But that's basically it when it comes to various different types of activities. So let me show you very quickly the calculations that I just talked about, and then I kind of just want to walk you through really quickly the basic stock markets and the types of things that you should be paying attention to. And then, guys, I know that I'm going to be running out of time soon. So actually, I might be like out of time. So just let me know when I should be stopping. But I do have a little bit more prepared. So just let me share with you very quickly. Okay, so as far as, okay, so this is the website that I will be sharing, and it has the 7 best budget apps. So you guys we talked about it a little bit. So you can go through and see what suits you best. Okay, as far as the actual stock exchanges, there are various types. And you guys, if you go to this website, you can actually see a list of all of the indices. So basically all of the stock exchanges in various locations. So on every single continent, if there is one, it will basically outline what it is and how well it's doing. So you can also just come to the map and like here it will tell you, Dow Jones, SAP, and NASDAQ, and how they're trending. Okay, let's see what else. Give me just a second. Then as far as the actual tick marks go, we also can see, if you guys just go to New York Stock Exchange, you can actually look through the list of different indexes here, and then you can literally just go through and figure out like what is the company that you're trying to invest into. And if you click on it, it will give you the information associated with the stock and whether it's doing well, what the beta is. And beta is the volatility indicator. So every single time you have a beta of lower than 1, it means that the stock is not as volatile as the market. So it also means that basically there is less risk involved and your earnings might not be as high. However, they're not as risky. I also have the information associated on the taxation every single time you're, whether it's a mutual fund or a stock, depending on the type of an event, it will actually tell you how you're going to be taxed, so that you guys keep that in mind and know that every single type of an investment will most likely trigger your taxable event. So make sure that you're choosing the option that will have the least impact on you. And then there are also other plans that I did want to talk about, again, running out of time, but 401k and IRA, which is the retirement account, individual retirement account, which you can start on your own. You don't have to have an employer help you with it. So there are a few websites here that I've actually found that are really helpful and summarizes the key pros and cons for having 401k versus the traditional IRA or Roth IRA. And then also, once you start having kids, you can actually think about opening an SEC 529, which is a plan basically where you can start saving for education of your child or children. And that's going to be tax deductible in most of the times. And then let me stop sharing and let me show you one more thing. Okay, so you guys, when it comes to basically this spreadsheet that I will be sharing, there is also a calculation for you to see the difference for that compound rate that I was mentioning. So depending on what the tax rate is, you have to divide it by 12 if it's compounded monthly, and then you can literally see what the difference is between having it compounding monthly versus not. And then if you guys want to retire with at least $1 million, and you can change this number to whatever the number you want, whether it's 10 million or whatnot, you can actually see how much you would need to invest today or how many particular payments you would have to make in order to end up with that amount in, let's say, 50 years. So at a 0.42% rate, which is pretty low, so you can probably increase it. And then for annuities, again, depending on the type of the annuity that it is, if you want to understand what you should be paying for the annuity right now, if you would like to get paid $1,000 everything for the next 10 years, you need to be prepared to pay at least $6,400 now. And then let's say if you are trying to understand that if you're buying an annuity that promises you to pay $1,000 at 9%, what the future value of it is, like long term, basically, what is the implication? How much would it be worth if you were to convert it 10 years from now based on the inflation? It will give you that amount as well. So then you can actually make an informed decision based on whether it's worth an investment or not. And then for stock calculations, you guys kind of can go through here as well. And I already have everything outlined. Again, I'm really sorry, definitely ran out of time. But if you have any questions, I do believe that my information is included on the pamphlet at the very end. So please feel free to reach out anytime. And if there are any questions right now, if there is like the 2 minutes, I can also take the time to address it.
Yeah, thank you. Thank you, Ilona, for the presentation. Does anyone have any questions? Feel free to speak out loud. Okay, in that case, I'll pass it to Christina to talk about our exit survey for the workshop.
Yeah, thank you, Ilona, so much for the wonderful presentation. I know we can all take a lot from that. So my name is Christina Hiraishi. I'm a second-year study data science, and I'm an internal operations member in Flejcon. So here's the link to our exit survey there. And so if you guys could please fill this out to give us feedback for our team and our speaker, that would be amazing. So once you've done that, you're free to go or stick around for our next workshop, which will begin at 2:30 Pacific time and will be on finances and nonprofits.